So if you have any question about what is an order block, I think this might be the last video that you have to watch to understand what is an order block. And just for you guys, a friend of mine shared with me this PDF long ago explaining what is an order block. I don't know which trader prepared, but it was shared to me by a friend. So maybe today I decided I may share it with you because it was helpful to me. So I'm pretty sure it will be helpful to you. And it has a lot of value. So if you really pay attention to this video, this video alone may help you prepare a full strategy for yourself. If you really understand, and it will help you not only understand what is an order block, but also understand the footprints, how the market moves. And you know that the markets does not move with just patterns, maybe the trend lines, something like that. It's not like that. So I think this video will be very helpful to you. So let's begin. Okay, so to start with this document, you have to understand some things first. So first of all, have you ever seen any big moves like this happening inside the markets? The big moves like this, you see the price pushing very rapid from some points, and you don't understand what's really happening behind. So what's the reason behind these big moves that are happening inside the market? Okay, let me break it down for you. So okay, now in order to understand what really causes this move in the market, you have to know the participant in these moves. Now, just the case for you, if you don't know that these moves are not being caused by the retail traders. Retail traders are not participating in these moves. I know most of us have been told that the retail trader, the sellers and the buyers, blah, 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 push the markets like this from down, up, but it's not like that. Now, the markets are really being engineered by liquidity. The market are fueled by liquidity. The liquidity is what pushes the market. So in this video, I think it's going also to explain that how liquidity is formed, how is it prepared, and how does it happen. Okay? Okay. So the institution, the reason why these big moves are happening inside the markets. Now, retail trader don't do any of this. Retail trader don't produce impulses like this. So what does it mean and how can that benefit us? So as retail trader, what we are trying to do when we see big moves like this, we just try to understand the footprints, what that have been left behind by these institutions or the smart money traders, what has been left behind by them. So if we want to anticipate, to want to predict the next move, we have to learn, we have to see, we have to be patient to see the traders, the sellers, the buyers, all the liquidity being taken out before we take our move. So we really know what is the direction of the markets. Okay, so essentially what we're trying to do with the strategy is we are trading the footprints that are being left behind by institution. So what does that mean? So we have a little example right here. So for example, maybe you're going in a very nice trend. So for the classic retail traders, we may use maybe an uptrend. We indicate it using trend lines, or maybe we're using an indicator like EMA, the moving averages. We all know there are a lot of them, the Bollinger Bands. There's a lot of things. So, okay, we think that the market is based on this pattern, but we fail to understand what is really happening in the markets. So, for example, right here, we got a very nice uptrend, trend line. We have the first touch, the second touch, the third touch. Now, so we have been in the situation where that we have the one touch, the second touch, and the trend line. So we use this retail trading strategy. We have these touches, so we expect to buy maybe on the third touch or the fourth touch. It depends on your confirmation, your rules, you see. And most of the time, what will happen is that we may have the first touch, the second touch. Now, the institution are aware of these strategies. So they engineer this liquid, they prepare these people. So we have the first touch, the second touch. Now, if the price comes up here, when it was up here, a retail trader already draw the trend line in this position. So he's waiting for the price to come down here to touch this so he can bought it up again. And the institution knows this, so they prepare something like this. That's why you find it when you go inside the market. And that's why this sometimes works, because if you teach someone, you have to prove to him that it works, but it is just probability, and we don't know when they are going to allow it to happen and when they won't allow it to happen. So if you want really to understand what they are doing, they are engineering liquidity, they are preparing liquidity. Here we have a lot of buyers. They buy orders from here. So on the third touch, and the institution may push this move, that's why after the third touch, you may see that you probably have some reaction from here. So, and then what happens afterward? Price decide to fly in the way that we are going to trade anyway. So you see that small reaction. We've seen it right here. This small reaction right here. Let me draw it for you. This small reaction right here. Right here. So price decide to move in our direction anyway. So we think, okay, right, we are in the right direction of the market. So we take our buy orders. And then now we are, after we see the move happening, we put our buy order, then we find this move. Price reversing against our direction. Now we start to ask ourselves question that maybe that probably was just a stop hunt and question like that, but it's real. These are the stop hunts. Now this is the aim of the institution. They need this. This is liquidity, so they have to perform these stop hunts. That's why you see them happening maybe every day inside the market. So what does it mean, and how can that benefit us? So using a standard retail strategy, we need to be aware of what is happening in this situation. So we need to be aware that this might be a stop hunt because we see this liquidity forming. And okay, we may have, before we proceed forward, let us have another example. We have the retail strategy we call trend line, support and resistance, leaving behind the trend line and something like that. So also we have something like that. They prepare liquidity in this form also, the support and resistance, the classic support and resistance. So you have the first touch, the second touch, maybe the third touch. So you draw your support like this, as we've seen here. So trader draw support like this. We've seen it right there. But what then happens afterward? We see that after the third touch, I must say, buyers, like always, decide to buy. So they wait maybe for confirmation on the lower time frame because we see some reaction. So institutions, they want to give you the reaction because they want you to maybe find your confirmation and something like that. So you're going to see this reaction. Say, okay, now it's buying. Let me buy because we have this price stop here, price stop there. Now probably price is going to stop here. So the price reacts at this position. Then what happens? Stops get taken out. Now, if we really know, if we want to trade with the smart money, we have to be patient. So we see all of these things happen. We don't take a trade yet. And I really want to emphasize this. Don't take any trade yet. Wait for the footprint to be complete. Now, okay, let me read it for you. So, have you ever been in a situation where we have got strong support level? You look to enter trade at this support level, then we are having to get more reaction, which is fine. Then we get taken out, and then price continues. So we have got this strong support. There's a lot of support and resistance trade, and we are probably thinking we've just been taken out. My stop loss has been taken out. So it's just explaining what's happened right here. So we think maybe we're in the wrong direction of the markets. Then we have, after seeing that maybe we're in the wrong direction of the market, so we think that, okay, this is a breakout now. Wait for the breakout, so we go for an entry for breakout. Then what happens? Again, the breakout trade gets taken out. So in this situation, we alternatively might decide that we are going to take a breakout trade, but also gets taken out. So those are the buyers and the sellers. All of them get taken out. There were sellers right here from the breakout. There were sellers from this resistance level up here. So let me draw it for you. Okay, I think this may be fine. So we have this resistance level up here. We have sellers from up here. We are going to have sellers from this breakout right here. We'll think that, okay, now it's a breakout, so we are going to take sellers. So we have taken sellers from up here and sellers from down here. Then we have buyers. We have buyers from this position right here. We have buyers buying at these resistance levels. Also all of them, especially at this position, because we think that at this point and this point, it was just the institution preparing this move. So to deceive the retail trader. So at this position, we have to wait for we wait and we saw that they moved in the opposite direction. So now we know that they're not coming. They're not moving in this direction. Now we know that the sellers From up here, the sellers from here have been taken out. Also, the buyers have been taken out. Now, what next? We see this move, this explosive move to this side, to the upside. Now, that's the real move. That's what we've been waiting for. That is the footprint that we've been waiting for. So let me continue reading this for you. So, and why that's okay? So that is what we need to think about. Why does that happen all and over again? All over and over again. These strategies are based on probability. However, ignoring what is actually happening in the market and who drive the market when the price is being pushed down and then goes up in our favor. What we realize is that price is, I think there's some kind of error there, typing error. But what really means that this is happening all the time. We see these sweeps. So it's not a glitch or a problem with the markets. No, it's planned out. It is engineering. It's prepared to take the liquidity. Okay. We see this, then we see this big move. Now this is the footprint. We know that they always wanted to go long. They always wanted to buy at this position. But when we have to be patient. Now, okay. So why that there are price? Why does the price do this? And it goes from here, then comes back down, and then what is this? What is this? So what is trying to say there? So what is this? What is happening right here? So let me explain it for you in simple details. Okay, we have this trade right here. We have this support and this are forming right here. Then we get the sellers and the buyers gets taken out. Then what we have to do, we have to wait the price to come back down, then to buy. So why do we have to wait right here? And why do we have to buy at this position? This place right here. I'm talking about this position right here. Why do we have to wait to come and buy at this position? So what you're trying to do is, okay, let me break it down for you. Now, the institution don't use stop losses like us. They don't use the take profit and the stop loss like we use. They mitigate their orders. So let me have a quick explanation for you. Let me go back down here. Okay, so as we have said that they engineered this liquidity from this position. We have the buyers, we have buyers, sellers, buyers, sellers, buyers, sellers. We have the liquidity forming from the sell side, the buy side liquidity and the sell side liquidity. Now, the buy side liquidity gets taken out, then the sell side liquidity gets taken out. So now we know that we don't have liquidity, but they engineered this move. How did they engineer it? So when our point of interest starts here, they placed sell orders to take this buy side liquidity. Then they placed buy order to take for the actual move, which also takes the sell side liquidity from up here. So from up here, from the breakout traders right here, and also we have seen the breakout traders from, above, I've explained it, and also from the sell side, from the sellers up here. So what they are trying to do is, now we have to go for the actual move, because we've seen the footprints, what they are trying to do. They are trying to take the buyers and they are trying to take the sellers, and they've done that. And we are patient enough to wait for that. So what happens next? I want to explain the logic. Now, as I've said, that these guys don't use stop losses. They use the orders. They mitigate the orders. So they place the sell. So we see the first, maybe we have the first, the second, and the third candle. Now, which means that this is the first place where they sold, then they sold again, then they sell again. You see, now we come back and try to understand what is the order, what is an order block. Then they bought it, then they continue to buy the price. Now, so comes to the question. So what is an order block? We say that an order block is the last opposite candle before the big move to the opposite direction. So if it's a bullish move, it's the last down candle. If it's a bearish move, it's the last bullish candle. So if they sold here, they sold here, and they sold here. This is the last place where they sold. Now this is our order block. After seeing all these moves, so don't look at every down candle as an order block, but you have to understand what is really happening. It's not that every down candle is an order block. Not every down candle is an order block. Some down candles are not order blocks. So you have to see something like this, the liquidity being taken out, the buyers and the sellers. Now that is a high probability order block. That's an order block, high probability and order block. Also, another thing that we really have to know is that if they are going to come back, they are going to mitigate the sell orders from up here. Let me draw it for you. Reduce the thickness a little bit. Okay. If they are going to, let me delete it. If they are going to mitigate the order, they have first to mitigate the orders from this position. Then they have to mitigate the orders from this position. Last place they sold it was here, so they also have to mitigate the orders from this position. Now this is an order block because this was the last candle before the up move. Now this is our position, this is our point of interest because this is the last place that they sold. Now if we are thinking about entry, we be patient and wait for the price to come back to this position. Okay, let me delete this. Okay, so okay, just an explanation. So as we can see that the price come back at this position, then again price moved to the opposite direction. I think for some of you, just to be helpful to you all, I may share this PDF. So you may leave a comment below so I can share a link with you where you can get this. This PDF. Okay. Okay. Now let me go straight to what is an order block. So come to the main topic of this video. So what is an order block? What is an order block? This is what we've been trying to understand all along. So the order block is basically the last place where the institution have placed their orders before the move happens. So if we think about this about it from this perspective, where that position, as I've said, that this is the last place where they sold their orders. So this is the last place where they placed their sell orders. So this is the last place where they will come. They'll bring the price back to mitigate their sell order. They don't want to operate in losses because if they leave this order without mitigating them, they'll continue making losses because the price will continue to go up and they have sell orders which have not been mitigated yet. So they have to come back and mitigate these orders. So they will come back at this position to mitigate their orders. That's why we call it an order block, because the last place that they placed the sell orders. Okay. Now, so what does it mean? This is the order block. This is the last place where the institution sold before the price is pushed up. Okay, I think this is a very important. This is the last place they sold before the price, so they need to come and mitigate their losses. They need to close it either to break even or take a small loss, and then they can continue to move as they always do. So they have always wanted to go bullish, right? But they need first to close out this trade. This happened time and time again. So they always wanted to go bullish, but they had to take the sellers and the buyers first. And to do that, they placed the sell orders. Now, in order to continue going bullish, they have to come back and mitigate these orders, maybe to take a break even, or maybe take even a small loss, because they're going to make a lot of profit going up, but they have to take a small loss going lower, or maybe break even, or maybe mitigate the orders. Now, so they have to bring the price back down. Okay, now, so what does that mean? How does that benefit us? How does that mean? As we know that the mitigation needs to happen, so the price is going to come back down. So we are going to look to enter at this mitigation because we know that price is coming back, and we are basically looking to take a trade from there to continue the move with them. We're just following the footprints. Now we've seen that. If we want to understand where the footprint starts from here. We see this. We see they've prepared the liquidity. They've engineered the liquidity right here. Then they took it from buyers and sellers of the breakout. Then they took it from the sellers who were up here. Now this right here, let me draw it in another color. Up here, this is a footprint. Now we know that they have to come back to mitigate their sell order. Now this is where we are waiting for them, so we can go along with them, we can get along with them. Okay, I think now you have a real understanding. Now this up here, this is the footprint that we were waiting for. So now we know that we have to come back down here. Now that's where we wait to come and maybe take our entry at this position down here. So it's not like everywhere we can take a trade. No, it's not like that. We have to be patient. You have to see the footprints. This is a footprint that we've been waiting for all along, I can say. So that if they wanted to go bullish, we are going to be looking for the last bearish candle before the bullish move that broke structure, and that's the next point, which is an order block. So for an order block to be an order block, it needs break of structure. This is what we call but BOS. I mean, some people say BOS, some people call it BOS, some people say it BOS, but I just call it break of structure. So what we see, the order block that has been broken structure, that has broke structure. So for an order block to be an order block, it has to break structure. If it does not break structure, that is not an order block. I think this is a very important point right here. It has to break structure. Again, I repeat this. It has to break structure. Now, for an order block to be an order block, it has to break structure. Let me draw it for you, this point. Okay. Anyway, let me just show you from the diagram down here. For an order block, for this is the last candle before the move, this one. Now, for it to be an order block, it has to break structure, and we've seen that it has broken structure up here. So this is the last down candle. So what we know is when there is a price that breaks structure, for example, it goes down. So like there, price breaks structure at this position, as we've seen right here. We know that the institutions are responsible because retail trader cannot break structure, cannot have the strong movement that may break structure. So for an order block to be an order block, it has to break structure. So now we know that this is a valid order block. Okay? Okay, so I think that's the same explanation. So, okay. Now, from here downward, I think the PDF just tries to give you a deeper understanding on what is an order block. But I think the key points that you have to remember, you have to look for the footprints of the smart monies. Then, once you've seen the footprint, you have to wait for your entry. But before you wait for an entry, when you select your order block, make sure that your order block has broken structure. Now, there is a lot of detail to this, but the video might be too long, so I think I might end up here for today. But if you really want to understand, and I think up to now you have understood what is an order block, because you have understood what is the footprint behind it and what happens. And also, for an order block to be an order block or to be a high probability order block, it has to break structure. Okay, so thanks guys for watching, and I think if you really want to have a look at this PDF, leave a comment below and I'll send it to you for free. Thank you everyone.